Today, I wanted to talk about something that's been on my mind a lot lately. And I'm sure if it's been on my mind, then it's on your mind too. And that's a question, is it time to just sell everything? With it looking like everything's moving in a negative direction, wouldn't it make more sense to take a cautious approach and not blindly keep investing? Remember all that hate when Meet Kevin decided to sell his $20 million portfolio back in January? He was called an idiot who's giving bad advice, doing it all for the views. Well, when we look at where we are today, well, maybe he was right. Today, let's talk about why selling is good and why it's bad. And then I'll tell you what I'm personally doing, so make sure you stick around to the end, subscribe and smash that like button for the transparency. Now the market seems to be balancing on the edge of a cliff, with the S&P 500 already down 17.5% from its peak. There's a feeling in the air of uncertainty and doubt in terms of which way the market will go. But the general direction everyone and their dog is telling you is down. As the outlook dims with the UK economy shrinking for a second month, the dollar rising to an all-time high, costing companies billions in earnings, and the S&P 500 headed for bear market territory, it's no wonder people are getting concerned. Now, I have to be a bit cautious with this kind of video, because it would be quite easy for me to sway your opinion. If I tell you reasons you should sell, you'll think it's best to sell. And if I show you reasons why you shouldn't, it'll send you the other way. Some of these videos you'll see on YouTube are incredibly detailed to the point that most everyday people like you or me just wouldn't understand them. Or you think they must be right as they look so well put together. Well, in most cases anyway, they don't know. Or they just haven't been investing long enough to know. When you look at the chart of the S&P 500, it's very easy to think this is a bottom, or this is the bottom, or maybe this could be the bottom. But the truth is, trying to guess in this way is what experts like to call charting. Looking for patterns in the chart that will repeat themselves, which in itself is a very controversial topic. Personally, I don't think charting matters. It would be great if it was that easy. I especially don't think that charting matters to an everyday investor. There's plenty of videos out there telling you how the stock market will crash, but put simply, it's this. High rates of inflation. Between all of the stimulus checks and the issues with supply chains, there's been a dramatic increase of the price of, well, everything, as I'm sure most of you are feeling, which has led people to be more cautious, and in general, people are just spending less money. Interest rates are being raised in an effort to help fight this, and more will continue to come. This could slow down inflation, but it could also just trigger a recession. We've also got the tensions in Europe with the Russian invasion of Ukraine sending shockwaves around the world, which also hasn't helped. But if history shows us anything, it's that the stock market usually recovers and is higher a year after major geopolitical or historical events. Now personally, I don't think we're in for a dramatic crash, although it might look quite dramatic because of the sheer height of the S&P 500. If you actually look over the past year to date, you can see an 18.57% fall in the first 6 months of this year. That's over half a year of red. There was some recovery along the way, but generally it's been a slow downward trend. And if I had to put my money on it, that's what I think we'll continue to see over the remainder of this year. A slow downward trickle. Because I don't think we're going to see any crazy events that no one expected like we did with coronavirus. I mean, some people saw that coming, but a lot didn't, at least to that scale. Of course, on the flip side of this, there are positive things to come in the future. Hopefully, fingers crossed, the Russian-Ukraine war will come to an end and supply chain issues have been resolving themselves, although inflation is now hurting that. I know in my lifetime, I've never experienced prices going up so harshly. At the moment, it seems like things are going completely out of proportion. Inflation at the moment is around 9%, and the price of my supermarket items is jumping 20 or 30%. Of course, a lot of other costs come into play, but it seems pretty crazy. At some point this has to give, because it's not like our wages are magically going up alongside it. If anything, companies are cutting back on spending and not raising wages because they're just losing money in other aspects of their business. This is really what blows my mind, because inflation's going up, the cost of living is going up, gas, electric, food, fuel, wages aren't increasing, but somehow there's still queues of people waiting to buy houses at £500,000. Yet, no one's got any money. It just doesn't really add up. Now, I'm not a genie and I can't predict the future, but with the general idea that the market is headed downward, isn't this a point where it just makes sense to sell everything and wait? At certain points, it's clear that selling and rebuying lower would have been a really good decision. Here's 10 points in the past 5 years, selling the S&P 500 and buying at a later point would have made complete sense. And you can see why from looking at how long it took to recover. In fact, from Jan 2018, it would have taken you over 2 years to recover. It gets even more concerning when you look from 2000, where you could have sold everything, waited until 2013 and been better off, and 2007 where it would have been the same. Leave the money in the bank for 6 or 13 years and you would have ended up with more. Now of course, looking at those examples, you would have been incredibly unlucky, and a lot of people have been. I always hear of horror stories of people invested right before the crash. I actually did the same thing. In fact, I invested the day before everything crashed in 2020.
Well, that's not good.
But luckily I had more cash to invest, and I invested at the bottom and made the best returns I've ever made investing. Realistically, your timeline should look more like this, where you consistently bought and rode the wave. But that being true doesn't escape the fact sometimes it makes sense to sell. There's this thing that seems to be long forgotten about when it comes to investing, bizarrely as it's one of the most common terms in investing, and that's take profit. Traditionally, everybody should use a thing called stop losses, i.e. sell a stock when it dips too low. Now this is normally used when people are taking more of a gamble on a stock and don't want to lose too much money, or it just doesn't go the right way. Still a very good tool that everybody ignores and never really mentions. But the other is take profit. Once you've made a significant amount of profit, take it, which is something most people definitely won't do. For example, people who bought Tesla stock pretty much thought they were on an upward skyrocket ship which would never end. But in fact, if you bought any time prior to mid-2020, it's probably a good time to cash in some of that 800% profit. Yep, 800%. Now if you're like me and didn't bank an 800% profit, this can apply to a lot of your other shares or ETFs too. Taking a chunk of profit from a company you've made good gains with can be a very good idea. I'll do this on a regular basis if I think there's a better opportunity elsewhere. Or like right now, it's a good idea to do it if you want to be holding more cash. So why might you not want to sell everything and just keep holding it? There's a few reasons, but the most important reason is this. You don't want to miss the best days of the stock market. The Bank of America ran data and found that going back to 1930, if an investor missed the S&P 500's 10 best days of each decade, the total return would stand at 28%. If on the other hand, the investor held steady through the ups and downs, the return would have been 17,715%. How crazy is that? And if we look more recently, in the past 10 years, we can see the impact of missing the 10 best days in the stock market. 10,000 would have ended up at 13,610 if you missed them, or 27,417 if you stayed invested. Now what both of these fail to do in the issue of fairness is show you what would have happened if you missed the worst days, because really that's what most of us want to miss. Here's a return over a year in the S&P 500. First, missing the best days. 6% return if you stayed fully invested, 2.44% missing the 10 best days, 0.08% missing the 20 best days, and minus 1.95% if you missed the 30 best days. Now on the flip side, if you missed the worst days, 6% again if you stayed fully invested, 10.07% missing the 10 worst days, 12.89% missing the 20 worst days, and 15.37% if you missed the 30 worst days. So actually, looking at this example, it's the worst days that you want to avoid. But the problem is, unless you really are psychic, you aren't going to be able to time this at all. So you've had all of that stress and mental capacity drained trying to work out when to buy and sell the market, and you've actually ended up matching the market if you're lucky. More likely than not, you've probably done worse than just leaving it in there. And this is because you have to be able to consistently time it, which if you could do would be pretty amazing. You would pretty much be Rain Man. The other huge consideration here is that the longer you invest for, the less important the entry point actually means. Does it really matter in the long run where you bought in the past if you bought consistently? I think probably not. So now we know there's some arguments for timing the market as well as not timing the market, which everybody tells you. Let's talk about what I think you should do. Not financial advice, but this is what I'm actually doing. I'm timing the market. Yep, I'm doing what everybody tells you not to do. In my opinion, it's pretty obvious that things aren't going to be smooth sailing this year. And as much as I started my 0 to 100k series investing at the peak of the market and want to blindly continue to invest in it, average in, as a good old saying goes, I want to be a bit smarter about it. And to do that, I'm going to time the market. Not by selling everything and waiting to see, which arguably may even work out for you better at the moment. I'm sure it has so far for me, Kevin. And the way I'm going to do it is by increasing my cash cash positions, which oddly is something no one really mentions. A good portfolio should always have cash. Berkshire Hathaway, Warren Buffett's company, always has around 30 billion cash in their portfolio. Some people think it's stupid, but realistically, they are always looking to buy good value companies, and they want the cash available to do so. This is an important part of value investing and stocks in general. You want to buy when stocks are good value and not when they're stupidly overpriced. Even with index funds, you don't really want to be buying them when everything's super high. With my portfolios, my aim is to increase my cash positions to a minimum of 30%. I feel like the markets are going to dip at least another 10%, so I'll see what happens. And I'll average in when things get lower, and then I'll just resume my continued buying. Heck, if things look awful one day, I'll probably just buy some more. Cash is a weird one, but it's actually important. The smarter thing to do at the moment would be to actually not put your money into an investment account until you have to. Maybe store it somewhere like Chase with their easy access 1.5% rate. I'll pop a link down below to that one, as you do get a free £20 when you sign up using that link, so it's worth having a look at, and that's where I put my cash at the moment. Another alternative for your cash would be premium bonds, but there may be a delay in buying and selling those, but again, they're government protected and super safe. 1.5% might seem a marginal amount, but compared to minus 10% in stocks, it's more like 11.5%. Now I hope this has given you some clarity on the situation. I will continue to share my portfolio with you guys right here, so do subscribe and follow the journey. If you missed my last one, here's an update, and I think you might also like this one. As always, thank you guys for watching, and I'll see you guys over there.
Just wanna see the light.